But the point is, you're still going to get that trade deficit. And if you get that trade deficit at a time of declining production, who gets hurt? The domestic producers. This is the way in which tariffs and trade protectionism, introduced at the top of the credit cycle, kills the economy.
Welcome to the Silver Doctors exclusive. Today I'm excited to have a returning guest, Mr. Alasdair Macleod, the head of research for goldmoney.com. Today, Alasdair is joining us to share his thoughts on the global economy, the importance of gold, the future of the dollar, as well as his projections on the possible presidential 2020 election. So, Alasdair, welcome back to Silver Doctors.
Very much my pleasure, Mike.
Well, it's great having you to join us again. As I mentioned before we went live, it's important, and I think a lot of people value your commentary because you do a good job of covering a variety of subject matter. And so today we're going to hit on a few things. But before I dive any further, I want to kind of get an idea as to what are some things that you've been keeping an eye on. And so we're almost halfway through 2019, a lot of things happening globally. And so what are some things that concerns you or really has you excited from an opportunity standpoint?
I think the thing that concerns me most is the conjunction of tariffs, American protectionism, at the top of the credit cycle. The last time this happened was 1929. Now that should ring some alarm bells amongst your audience. And the reason it's so important is that in October 1929, on the 30th of October, Congress passed the provisions of the Smoot-Hawley Tariff Act. Now, that was the month when the Dow Jones Index fell 35% top to bottom. It didn't close 35% down, but that was the extent of it because of obviously market participants could see this one coming up in the lift. And then there was a recovery in the Dow, which lasted about 6 months. It took it to sort of almost halfway through 1930. And then the bear market really started. And the Dow lost just short of 90% from top to bottom. Now, I think the conditions now are slightly different insofar as in 1929 to 1932, we had a gold-backed dollar. In other words, the dollar reflecting prices in gold rather than in dollars, as they do today. And so with an unbacked fiat currency, there will be differences. But I think nonetheless, we can say quite clearly at this stage that there is a high risk with the protectionist tariff policies from the American government, combined with the top of the credit cycle, just as it happened in 1929, there's a very high risk that we will have a nasty 2019.
That's 2019. And actually, as of today, as we're speaking, I think I saw some articles that mentioned about President Trump mentioning about tariffs again and the Chinese market dropping a little bit. I heard the Dow start off a little slump today. So could this currently be the beginning of something where we see it this summer or any type of time frame as to the official bear market type of thing with the equities market?
Well, time frames are always difficult. I mean, all I can say is that it is in the works. And when it actually breaks, we will know after the event. Yeah. But there is no doubt that with President Trump tweeting that he was going to raise tariffs 25% and extend it to all Chinese goods, imports into America, that was, I think, very bad news. And what we had was the global stock markets falling very heavily on this news. The Dow opened some 300 points down, but I think it's recovered. Plunge protection team is in action. That I don't know. I think that it is a nasty situation, and my personal opinion is that I think investors should be very, very cautious about this situation, watch it extremely closely. I think that 1929 precedent is very, very important.
Interesting. That's very, very alarming, as well as you mentioned, investors should keep an eye on that. And so let's just play hypothetically moving forward if there is a major dip. And so in your opinion, based upon the fact that we're no longer backed by gold, the gold is not really in the people's hands the way that it was, several decades ago when it was labeled as money directly. And so from the equities dropping, how low do you think it can go? Do you think there could be over half? Or I've heard a lot of commentators mention it could be wiped out completely. And then some people say that the plunge protection team and monetary policy will definitely intervene and shoot it back up. And what are some possible scenarios you think of what could happen?
Well, at the outset, I should say I don't give investment advice, and I don't make forecasts. All I can do is draw people's attention to the conditions that we face. That said, I would not be surprised if equities more than halved. The dynamics in that are, I think, really quite concerning. If you understand the twin deficit phenomenon, now what that means is that when you get a large budget deficit, you tend to get a large trade deficit. This is assuming that the savings rate doesn't take up the difference. In other words, if you get a big budget deficit, it leads to the creation of credit, which means that people spend money on things they have not produced. That inevitably means imports from abroad. And that's how the two twin deficits, if you like, arise. We now have a situation where, as America goes into recession, the budget deficit is going to escalate. That is clear. So what are people going to do with their income? Are they going to increase their savings? I would suggest that the history says no. They may increase it a little bit as they are worried about uncertainty, but remember that the average consumer in America has got hardly enough money to see him through to the end of the month. And he's running credit cards and all the rest of it. So he is in debt on his current spending as well as his mortgages. So it's a very different situation, if you like, from an economy which can suddenly up its savings by cutting back on current consumption. Therefore, if you get an increase in the budget deficit, you're going to get an increase in the trade deficit. Now, forget the fact that there's a 25% hike on imports, tariffs on imports and all the rest. That is immaterial. That means that people don't make an awful lot of money selling to America, and it puts prices up for ordinary individuals on imported goods. But the point is, you're still going to get that trade deficit. And if you get that trade deficit at a time of declining production, who gets hurt? The domestic producers. So this is the way in which tariffs and trade protectionism introduced at the top of the credit cycle kills the economy. Wow. And I think if you can understand those dynamics, I know it's quite hard for people to grasp, but if you can understand those dynamics, then you can see how suddenly the rosy outlook that, don't worry about equity prices, it's a function of interest rates, and if interest rates go down a little bit, it means that equities go up. That is not the point. The point is that production is going to get killed by the combination of tariffs on imports and at the same time, an increased budget deficit.
Now, speaking of budget deficit, just this past February, we set an all-time high, $234 billion within a single month. And so that leads me to worry, where is this additional funds going to come from if the deficit continues to go up? Like if tariffs will impact our creditors, where will the funds come from? How will they make up the difference? How does all this turn out?
Well, that's an extremely good question, because at the moment, the foreigners are tending to reduce their purchases of, the recycling of goods to America. And we have seen over the last 3 reported months that the tick data, the US Treasury tick data, shows that private corporations have been selling, they've been net sellers of US dollars and US Treasuries. Governments have been selling, they've been reducing their overall treasury position for some time now, I think for about 2 years. But this is a new factor. We're seeing that the people who actually make goods to sell to America, which is not governments, it's private corporations, they are now reducing their ownership of dollars. Now, this is a very important development because America has been relying on the recycling of those dollars earned from sales, if you like, into America, net sales into America, to fund the budget deficit. That is going. So what that means is that QE will be introduced, I think, sooner rather than later. And there is a problem because when it comes to what the right level is, if you like, to fund in terms of interest cost, the market is bound to demand a far higher level of interest rate on US treasuries as people begin to realize that this foreign money is not being recycled, it is being sold. And the other side of that, of course, is if the foreigners start selling dollars, then the dollar is going to go down. Not necessarily against other currencies, because it's a very mucky market, and governments manage their currencies against the dollar. But what will happen is that you'll get, I suppose, something which equates to what people call stagflation. An economy that is going nowhere, an economy that is going backwards, yet at the same time, prices are rising.
Interesting. Now, you hinted on debt and quantitative easing, and you say it's coming. And so it happens to be at the same time where we have the Fed not choosing to move interest rates, and then we have a president, for the first time in my lifetime that I'm aware of, basically commenting openly and publicly against the Fed, telling them that we need to cut rates and start easing. And we're it's not as much as it used to be, but we're still being told our narrative that we're in an economic expansion, the economy's booming, GDP is 3 point whatever. So we're told all of these good things, but yet they're still requesting some easing. And so do you see easing becoming a new monetary norm like it's been for the last decade, and even more so into the future? And until what point will that work?
Well, I certainly see easing coming in, really, because government won't be able to fund itself. And already the interest cost of government debt has begun to take off. I mean, it really has. Something like, I think it's 20 odd cents, or it could be 27 cents. I can't remember the figure of every dollar raised, as it were, is spent on interest. I mean, you know, this is, if this was a corporation, you wouldn't lend money to it. I mean, it's as simple as that. So they've got themselves, I think, into a real debt trap. And the only way to avoid that being sprung sooner rather than later is to reduce interest rates as much as possible. The funding will be short-term at zero as much as possible. The Fed will be buying government debt, monetizing debt. And the excuse, if you like, for monetizing debt is they'll say, well, we've got to stimulate the economy. But we actually know the real reason for it is it's the only way the government can fund itself. And the problem the government has is actually a very serious one. It's the same problem that every Western government with a significant welfare state budget has. And that is, by law, the governments are mandated to provide, whether it's healthcare, pensions, unemployment benefits, whatever it is. And this is a major cost. You cannot cut it back. The only thing that President Trump can do is actually cut back on his military budget and the security budget. But the interests there, I think, are so powerful that I don't think any president can really override it. If you like, the establishment wants the money. So I can't really see where the US government can cut an escalating budget deficit. And the result is, I think you're going to see QE sooner rather than later. You're going to see a currency which, after a short period of time, is going to turn tail. And on that basis, commodities in particular, because I can't forecast what's going to happen to the euro, for example. I can't forecast what's going to happen to the yen or the Chinese yuan. But what I do see is that the dollar has an inherent weakness in it. And the other thing that is worth making clear is that when you get a slump developing, people who trade with America are going to adjust their requirements for a reserve of dollars. They're going to say, we don't need so many dollars as we thought we needed yesterday. And this basically means that they will sell down their existing pile. Now, here America has a problem because on the last figures we have, foreign ownership of US dollar assets plus cash deposits in the banks totals a short $25 trillion. American ownership of assets abroad is far, far less. So if you have an economic condition where people are drawing in their horns and reducing their overseas operations, because the thing you've got to do is protect your home base, then the dollar will be sold net against everything else.
Wow. So all this information you're sharing is in a time where, we're not even halfway through the year 2019, and there's a lot of people talking about a recession. And more importantly, a more notable commentator, Mr. John Williams from Shadow Stats, in a prior interview just mentioned that recession is currently underway now. And so all this policy and all this implementation of quote funny money is about to be rolled out in a recession, and there's no wiggle room to drop rates. So can you see a time, and will there be negative rates in the U.S.? And as far as savers of dollars, as you've been painting a very grim picture of the dollar, how will that impact those that have saved large amounts of Federal Reserve notes as well as other currencies? Because it's going to be, I believe, a global contagion of just events. How does that impact savers directly when the policy implemented, that's about to be implemented, really come home to roost as far as savers in the bank accounts and things of that nature?
The whole point of government printing money is to transfer wealth from the ordinary people, you and me, to themselves. And so the rate at which we are impoverished, if you like, through monetary inflation is bound to increase. So that is the overall effect. You mentioned John Williams, which is a very interesting point, because John, for a long time, has been telling us that the real rate of inflation is considerably higher than the official figures tell us. And we get also confirmation of this if you look at the Chapwood Index, which is, I think, calculated twice a year. That tells us that for the last 5 years at least, we have seen in America price inflation on the things that you and I actually buy, as opposed to things in an index which we buy once in a blue moon. That rate of inflation is probably running at something like 10% a year after year. That tells us two things. It tells us that actually our money is losing value far more rapidly than the markets seem to understand. And the second point about it is that if you assume that the figures that John Williams uses or calculates are closer to what the deflator for GDP should be, then we've been in a slump since 2008 and probably before then. So, this is a sign that basically government finances are becoming so rapacious, they're just stealing money from their population's pockets to the point where they haven't got any left. And this is another problem we have on top of the cycle. It's not just a cycle of, credit. The creation of credit, which is primarily to fund the government spending, has continued the whole way through the cycle. And so we're getting into a situation which is a lot less dramatic, perhaps, than Germany in 1920 to 1923. But my goodness, the dynamics are there.
Interesting. Now, I want to transition into what has also been gaining a lot of attention in mainstream media. It has to do with the recent Basel III Bank of International Settlement, basically labeling gold money again, or as a top tier 1 asset. And so is there any coincidence that as the world begins to unravel in this debt-based fiat currency system game, that the banks are now able to keep gold on their balance sheets as a pure 100% asset? Is this coincidence, or is this probably by design, in your opinion?
I don't think, well, yes, I think it probably is slightly coincidental. I know that organizations like the World Gold Council have been working very hard to try and get gold recognized as cash and not disadvantaged, if you like, as a sort of commodity or quasi-commodity. So they have been very successful in that, and I think we've got to tip our hats to them for that success. I think the coincidence is that we are where we are when that has finally come through. I mean, there is another thing which I know the World Gold Council has been working on, and that is in Russia to remove VAT, or if you like, sales tax on gold bullion for ordinary people. And we're very hopeful that that's going to come through in the next few months. And I think that is very important because the Russian central bank has made great strides, I think, in protecting the ruble from the dollar by turning the reserves from fiat currency into physical gold. Well, that, I think, is a very, very important step. To do that properly, what they really have to do, I think, is to remove sales taxes from the purchase of bullion by ordinary people, because then you have got gold in the system which can become money when fiat currencies collapse, which inevitably they will do. I mean, I'm not going to make a comment about the speed at which they collapse, but it is happening. It is happening as we watch. And I mean, so far it's been happening really since 1971 and even before then. So you can see that this is a long game. Governments, will suppress all the evidence and all the rest of it. I don't know when markets will wake up to it. There's bound to be a bit of a horror show somewhere down the road. But if you're going to prepare yourself for the time when fiat currencies no longer have value or credibility, then basically you've got to have gold in the system. And I think that is roughly where Russia is going. Right. And it's also, incidentally, where China has gone, because the Chinese citizens, as opposed to the People's Bank, have accumulated, I suppose, net of scrap, somewhere between 15 and 17,000 tons of gold.
Now, that was going to be my next question in reference to all the things that are taking place outside of the Western world, and that includes gold. I haven't heard much about the Federal Reserve Bank looking to accumulate more, or really any, I'm not sure about the UK. I know a lot of countries are repatriating their gold back. And so amongst all this activity in the gold scene, it becomes quite obvious to me that gold will be included in the days ahead. Now, so do you, and it's just an opinion piece as well, do you foresee a time where there will be some gold-backed currencies or the digital gold type of transfer, or what do you think? Well, how will gold be included in the future, in your opinion?
I think, yes. I mean, if you're going to escape the inevitable demise of fiat currencies, then you're going to have to back your currency with gold. And it must be done creditably. I mean, the reason I think a country like America or Britain, or indeed most of the continent, irrespective of the gold holdings they have, can't really back their currencies with gold is because they won't change their spending habits. They will never run balanced budgets. That is the sine qua non, if you like, of having a gold standard which will work in perpetuity. I mean, we have to assume in perpetuity because that's what it's got to be designed for. Obviously, it may not be in perpetuity, but that's what it's designed for. The two countries which can do this are the ones which don't have huge, great welfare state commitments. That is important. But bear in mind my comment earlier about, it's the welfare state commitments which are killing us, basically. And those two countries are Russia and China. Now, I don't know whether they will move on to a gold standard, but all I can say is that they can do it. And the mechanism for doing it is actually not all that difficult. Assuming the state does hold a reasonable reserve of gold, then it is quite simple for it to issue a bond. And the purpose of this bond will not be so much to raise money, but maybe to consolidate some debt, but principally to pay a coupon either in the currency or in gold at a fixed rate. And it's that sets the rate, as it were. That bond would be a perpetual bond. It will have no final date, which basically means when the price is down, if you're prepared to take a risk, say, buying such a bond issued by China, you will be rewarded once more stable conditions return to the economy and the yield on that bond has fallen. In other words, the price has gone up. And this, if you like, is a lesson that we learned in this country following the Napoleonic Wars. What happened then was that the government of the day issued tranches of what were called consolidated loans. And these had no final redemption date. They consolidated earlier loans going back into the previous century. We needn't worry about that too much. But the point was that people with capital who were prepared to back the government during the Napoleonic Wars got an enormous reward. They created wealth. And out of that wealth came the capital, much of which spurred on the Industrial Revolution. It was invested in coal mines, it was invested in canals, railways, steam engines, and all the rest of it. And that was, if you like, in a sense, the backbone to this country's Industrial Revolution. And that is why Britain became so powerful in the second half of the last century. So it can be done, and we have a model for it. And I have calculated that if the Chinese issued a 1 trillion yuan perpetual bond, paying a coupon at roughly, let's say, a small premium of % or so, over the gold interest rate. Gold has an interest rate if you want to borrow it in exactly the same way as ordinary cash has. Then you're looking at around about 62 tons of gold being the annual dividend, assuming the gold price is somewhere north of about $2,500 equivalent. Now, what that means is that China, which has, I think, substantially more gold reserves than she officially admits to, could quite easily maintain the dividends on that bond at a cross rate which could remain fixed for a considerable time. And the reason that it can remain fixed for a long time is they don't have the welfare commitments, if you like, which are such a drain on the exchequer. And ordinary people, in the case of China, are savers. They save an enormous percentage of their money. And that, incidentally, is why the country has a trade surplus, just the same way as America has a trade deficit.
Right. Now, you hinted on welfare state and that being a possibility for how they can transition to the next world, including gold. Now, I want to transition for our last question in reference to the political season here in the U.S. coming up, or is underway right now, where because of the welfare state, we have the Democratic Party looks to be leaning towards offering a lot of more promises. And it happens to have the words free in front of it or universal in front of it, which will only further our problems even more so. But in your opinion, would you say that this could be the trend moving forward before there's some type of restructuring, reset, or whatever some people might want to call it, about government, predominantly the United States government, in order to actually take back the White House, having to promise free stuff, more of a socialistic type of approach?
Well, the left have always done that. They've always promised free stuff to get elected. I don't know if it'll get them in this time. There is the other side of this, and that is that if I am right, and the US economy and our economy over here in Europe is in for a very rough time, then the political scene is going to change, I think, quite dramatically. Just imagine another, I don't know if this word got much traction in America at the time of the Lehman crisis, but another period of austerity, cutting back on welfare as much as possible, cutting back on the provision of basic services, and all this sort of stuff. I can see that there would be an enormous democratic revolt against that, and it would be a revolt supported by quite a significant portion of the population. So we don't know quite how this is going to materialize. What you're going to need, I think, is a strong leader who understands economics and will be able to see it through with compassion as much as possible, given the constraints. So the question I think you have to ask yourself is President Trump likely to be that person? Right. I don't know. My own opinion, I think, is probably not.
Well, Alasdair Macleod, it's been great having you join us here on Silver Doctors. I appreciate you taking time to educate our audience here. Before we let you go, can you let the audience know where more people can find out where you post your work at?
Yes, sure, Mike. I write for Gold Money. If you go to goldmoney.com, you'll find in the menu Research, and I write an article under the Insight column, which is published every Thursday afternoon American time. And I also do a market report on precious metals, which is on the following day, the Friday before the weekend. And that's my weekly output.
Sounds good. Well, so once again, it's been great having you join us here on Silver Doctors. Look forward to continue to stay in tune with your work, and definitely look forward to have you back on later in the year, hopefully, as things unwind or and get your thoughts on it then. But other than that, have a great day. Look forward to continue to follow your work. Thank you.
Thank you very much, Mike.